going to bring in now iCapital Chief Investment Strategist, Sonali Basak. First and foremost, congratulations on the job.
Oh, thank you so much, Charles.
You've always been one of my favorites, and you're here to talk about all of this stuff.
Thank you.
Let's start with this ADP number, because in so many ways, this also reflects society in a sense that in this environment where the Fed has been restrictive, small companies have said we don't have access to capital. So the only ones hiring right now, according to ADP, are large companies. Everyone else, look at this, 20 to 49 employees shedding 21,000 jobs. How do we fix this? I mean, and what are the implications?
You know, I'm amazed that you looked at this too. This was the first chart that I looked at in the ADP data as well. 500 companies and more. Yes, you are 500 employees and more. You are seeing a rise. But the rest of the economy, these are the companies that have typically been the lifeblood of the American economy. It created the most jobs, so it matters the most for most people. I would say when you looked at the ADP report too, something interesting was that a lot of this was concentrated to the U.S. Midwest in particular. And remember, because we're not going to get that jobs report this week, people are paying more attention, but the ADP data is such a small subset of the overall economy, we don't really know where things are headed. That's the problem. We're in a cloud, in a place where the labor market is frozen. So how do you fix it? This is a really good question, because when people are investing in the economy, they're investing in large AI companies, and really those are not necessarily companies that are hiring in mass at that level.
So let's talk about earnings, which, you know, the mother's milk of all rallies is earnings. And what's interesting about October, this is one of the best months outside of January for pre-announcements. So maybe in the next couple of days, we don't have to wait, maybe we'll start hearing pre-announcements from these companies. What are you anticipating?
You're very wise to point this out, because we have been saying after the rally we had in September, the best September in 15 years, of course, you might expect a little bit of volatility in October, particularly because of the government shutdown. Now, remember, even with government shutdowns, you recoup those losses quite quickly. We are looking at January a little bit more, because you see that line is much bigger, but October, still you could expect some volatility. Our range was between 6,800 and 6,900 for fair value for the S&P 500. We're above 6,700 now, right? So we are very close to where we thought we would be at the end of the year, well before the year is over. So how much more upside is there when you see the S&P 500 trading near fair value? And by the way, a lot of kind of near-term headline risk. But with that said, we think that we could recoup those losses.
Okay, so the market is near where you thought it would be, but everyone on Wall Street may have to make an adjustment one way or the other. And you point out valuations. We can see the valuations. Here's the price to earnings ratio near that dreaded 1999, 2000 level. Price to sales ratio is completely off the charts, right? But it doesn't mean that the market has to slow down, right? I mean, that the market rally has to stop. And I think that's the conundrum for a lot of people.
I think the other problem with how people are looking at the market right now is they're looking at it as all one thing. When you look at price to earnings ratios, people say, oh, are we in 1999? That makes me a little crazy, doesn't it? Because the earnings are so much better now than they were in 1999 for those massive companies.
They're earnings now.
They're earnings, exactly. Charles, they're earnings. And so if you look at the price to earnings ratios for other types of companies, right? Financials, industrials, they're not as expensive as big tech companies are. Smaller companies, by the way, you're seeing that E-shaped economy in the market too. For companies under $25 billion in market cap, that price to earnings ratio, guess what it is? 15 or less.
Right. And that's more attractive. That's very attractive. That's maybe that's where money goes. But first, before it can go there, we've got to talk a little bit about the AI trade, right? AI disruptive. Not all software is created equal. Again, a very bifurcated market. Not just the market itself and the sectors, but even within these groups themselves.
Right. How much of the American public is looking at it at this granular of a level? When you look at how AI is impacting companies, we're looking at software. You have a lot of big tech giants saying maybe software is going to be seriously disruptive, and some of that is true. You're going to see application software hit a little bit, but infrastructure software, things that are dealing with the body, the meat, the bones, the skeleton of the AI build out, we're watching that closely. We would also say in the private markets, people are looking at data center build outs, things that fuel the boom in
that
AI.
Should last for a long time, though, right? The data center build out seems to be one of the areas that's hard to dispute. You could talk maybe about how vulnerable the grid is or whether it's up to snuff, but we're in an AI race. It's a global race, particularly America versus China. I don't think we're going to drop the ball no matter what party is in the White House. I think you have to keep the pedal to the metal when it comes to data centers.
Listen, it's not only that you have massive investors that are pouring money into data centers, you also have the big companies themselves in the world of AI and the heartbeat of it that are saying more and more companies are looking to finally use it at scale to generate better margins, but also sovereigns, other countries around the world. So when you're talking about that race towards better AI, the US or China, you also have to look at where Europe is investing. American companies.
Are you confident it's going to live up to the hype? You know, everyone keeps talking about the MIT report. Only 5% of companies say we've got a return on this so far. It still feels very early to even make such an assessment.
It's very early, but I would actually bring it back to where you started this conversation. What in the near term actually worries me more is you're seeing AI really start to make a dent in GDP. You could have it accounting for 1% of GDP. You've seen different estimates. But if you have GDP growing, but the labor market remaining stagnant and frozen, then if you're getting that growth without labor, what is the role of labor and how much do you see the economy really get more?
So with 12 seconds to go, stay in the market and ride out these bumps that are ahead?
If you see a significant pullback, we would actually even see those as potential buying opportunities, but I would be aware of the near-term risk.
Got to say thank you. You were fantastic. You lived up to all the hype. Thank you very much, Sonali. Appreciate you.